So you're ready to start investing. But the big question is, what should I actually invest in? If you're here, you probably watched hundreds of YouTube and TikTok videos talking about the 5 best ETFs to invest right now. But the thing that these videos don't tell you about is that the best stocks and ETFs for you to invest in is going to look completely different from everyone. Why? Well, it's because we all have different financial goals. And after helping over 100 plus clients learn how to invest their own money, no two portfolios look the same. And that's why in this video, I'm gonna walk you through the exact process I walk my clients through to help them build their own stock investment portfolio so that you can choose the best stocks and ETFs for your specific financial situation and goals. And make sure to stick to the end because I'll be sharing some of my personal ETFs and stocks to invest in. Oh, and by the way, this is actually part 2 of my 3-part investing series. And so if you haven't watched part 1, after this video, you can make sure to watch it. And so let me quickly recap what we covered in part 1 of this investing series. In part 1, we covered step number 1, which is to set your financial goals. We did this all in the money plan template. And if you want access to the spreadsheet, just go to the link in the description below. Once you receive the email to the link to the template, just create a copy of it and you can edit it on your own. And so once you've set your financial goals, step 2 is to build out your stock investment portfolio. Now, this is the part where most of my clients end up getting stuck because this is when they realize, oh my gosh, there are thousands of stocks and ETFs to choose from, and they just get really overwhelmed and in analysis paralysis. And so here's a little analogy that I use to simplify this process for my clients. I want you to think of building your stock investment portfolio like you're trying to make a healthy meal. Now imagine if you had to choose between individual ingredients. Should you make chicken, rice, beef, pork, potatoes? There's way too many options. And so instead of thinking of individual ingredients, to build a healthy meal, instead, you want to think of food groups. For example, a healthy meal consists of 50% veggies, 25% protein, and 25% carbs. Don't quote me on this, I'm not a dietitian. And so now, in order to build a healthy meal, all you need to do is to choose one ingredient from each of the food groups. We'll have lettuce, chicken, and rice. This makes building a healthy meal a lot easier. And this is how I want you to think about building your stock investment portfolio. Instead of thinking of all of the individual stocks and ETFs to invest in, instead, I want you to think of investment groups. And the 2 main investment groups are split between your asset allocation, which if you remember from part 1, it's split between high risk and low risk investments. And this is determined by your time horizon towards your financial goals, where for long-term goals, you can take a lot of risk, while for short-term goals, you can't. Now with each asset allocation, we can split it even further into a total of 6 main investment groups. And so today I'm going to explain the 6 main investment groups from lowest to highest risk and share some of my favorite ETFs to invest in for each of these categories. Let's get into it. The first category is cash or cash equivalents. This category is obviously the least risky. Now because your money is in cash, it won't go down in value, but it's also not really going to grow very much. And that's why you should only leave your money in cash if you plan to use this money within the short term, either 1 to 2 years. And if you want to do this, there are 2 main options for you. The first being a high interest savings account. A high interest savings account is essentially an account just like your checking account, except your money is actually able to grow at a small interest rate. The benefit of this account is that the money in here is 100% liquid, which means you have full access to it. The second option that you have is called a GIC, also known as a guaranteed investment certificate. This is when you lock your money in for a certain amount of time, but you're promised your initial principal plus an additional interest rate. Now, typically, I don't really love GICs because financial advisors love selling you these products because it's a really easy product to sell for novice investors. I remember when I was in high school and I was trying to invest for the long term, I went to my financial advisor and I was sold 2% GICs locked in for the next 5 years. Little did I know, I should actually be investing in riskier investments where I'm able to get a 7 to 8% rate of return per year. So this was some really bad financial advice. And this situation is so common. And that's the reason why I would only put my money in a high interest savings account or a GIC if I plan to use that money within 1 to 2 years. Now for my clients, if they want to open up a high interest savings account or a GIC, I typically recommend EQ Bank, which is a no-fee online bank that gives you some of the best rates on the market. And so if you want an extra $20 when you open up an account, feel free to use my referral link in the description below. The second category are bonds. To explain what bonds are, you're probably used to borrowing money from the bank in the form of credit cards or mortgage. Now, bonds are the exact same thing, except instead of you being the borrower, you're actually going to be the lender. And you're lending out your money to corporations and the government. And in return of lending your money, you're going to receive an interest rate. Bonds are a great way to add in diversification to your stock investment portfolio because they're typically, not all the time, negatively correlated with stocks. For example, if stocks go up, bonds would go down, and vice versa. The average returns that you can expect from bonds are about 3 to 5%. And here are some examples of some bond ETFs. The third category is gold. Gold is a great investment that can be used to hedge against inflation, as gold typically tends to retain its value when currencies are fluctuating in their buying power. And so essentially gold is seen as a very safe investment, especially during political and financial turmoil. As you can see with the recent uncertainty of the market with tariffs and trade wars, a lot of people have been flocking to gold because it's seen as a very safe investment during these times. The average returns that you can expect from gold are about 4 to 6%. And here are some sample ETFs that you can invest in. Okay, and so now let's talk about some higher risk investments. Higher risk investments can be split into 3 main parts: large cap, mid cap, and small cap. Cap essentially stands for how big a company is. This is calculated by taking the number of shares multiplied by the share price. For example, let's say Apple has 1 million shares and each share is worth $100. The total market cap of Apple would be $100 million. And so we can split the high risk investments into 3 main categories based on their market cap. The first category is large cap, which includes companies of a market cap of $10 billion or more. These are the giant companies like Apple, TD, Microsoft, Google, etc. And these companies are typically relatively stable because they're so massive and it's really unlikely that they're gonna go bankrupt. Large cap companies are also more likely to give out a dividend. And a dividend is essentially just excess cash given out to people who own a share by the corporation, typically on a quarterly basis. And so you should invest in large cap companies for short to long-term goals. And you can typically expect about a 6 to 8% return per year. And here are some examples of some large cap ETFs. The second category are mid cap companies, which includes companies with a market cap of $2 billion to $10 billion. These are medium-sized companies such as Equitable Bank, Aritzia, and Tricon Residential. These companies, although they have a high growth potential, they're typically relatively less stable than large cap companies. And you should only invest in large cap companies for medium to long-term goals. The typical rate of return that you can expect from mid-cap companies are 7 to 8%, and here are some examples of some sample mid-cap ETFs. And the last category are small cap companies, which includes companies with a market cap of $250 million to $2 billion. These are small-sized companies like Freshii, David's Tea, and Roots. Small cap companies have the highest potential for growth, but they're also the most volatile. Think of a startup. Sure, they have a high growth potential, but the risk of them potentially going bankrupt is pretty high. And so that's the reason why you should really only invest in small cap for long-term goals. The typical average rate of return that you can expect from a small cap company is about 8 to 12% per year. And here are some examples of some small cap ETFs. Okay, and there you have it. Here is a summary of the 6 investment groups that you can invest in from lowest risk to highest risk. And so now that you know what the 6 main investment groups are, all you need to do to build your stock investment portfolio is to follow these 3 simple steps. Number 1, choose an asset allocation for each of your financial goals, based on your time horizon as what we covered in part 1 of this investing series. Number 2, allocate your money between these 6 investment groups. And lastly, pick 1 ETF per investment group. For example, let's say we want to retire in the next 30 years. And every month we're going to invest $1,000. For this goal, we can have a high risk asset allocation of 90% high risk to 10% low risk investments. Then we're going to allocate our money between high risk and low risk investments. For the high risk investments, we can invest 30% in each of the 3 main categories. In terms of our low risk investments, we can invest 5% in bonds and in gold. Then all we have to do is choose 1 ETF per investment group. And so each month when we're investing our money, this is how we're going to allocate our money. And that's literally it. But just as a disclaimer, remember, don't just copy this stock investment portfolio. Remember, what you will invest in will depend on your specific financial situation and goals. And keep in mind that there's more ways to split the pie. For example, there are industry-specific ETFs, geography-specific ETFs, and ETFs in different currencies. But in this video, I just really wanted to simplify this process to make it easy for you to understand. understand. Now, if you want my eyes and expertise to build you a custom investment portfolio to help you achieve your financial goals, then apply to get a free financial audit with me. We have limited spots, so to apply, just go to the link in the description below. Okay, but now that you build your stock investment portfolio, you're probably wondering, how do I actually buy and sell these ETFs? Well, I'm glad you asked, because that's exactly what we're gonna cover in part 3 of this investing series. In the next video, I'll be comparing the top 4 stockbrokers in Canada, where you'll learn which is the best stockbroker you should use to invest your own money. And I'll also be showing you a tutorial on how to actually buy and sell your stock investment portfolio. And so if you haven't already, make sure you like and subscribe so you're notified when I release this new video. Or if you're watching this video in the future, I'll leave the link to this video right over here. That's it for today, and I'll see you in the next one.